BlackRock's Bitcoin ETF revolution, a game changer for crypto investing. BlackRock, the world's largest asset manager, has entered the Bitcoin space with its very own ETF. But what does this mean for investors and the future of cryptocurrency? What we'll discuss: an overview of BlackRock's Bitcoin ETF and how it works, the potential impact on Bitcoin's price and investor accessibility, how this ETF differs from other crypto investment products, the implications for institutional adoption of cryptocurrencies, expert opinions on the long-term effects on the crypto market. Here's an overview of BlackRock's newly approved Bitcoin ETF. It's called the Bitcoin Strategy Pro Fund and trades on the NYSE Arca exchange under ticker BITW. Unlike a physical Bitcoin ETF, this fund does not directly purchase or hold BTC. Instead, it seeks to profit from Bitcoin price moves via derivative contracts called non-deliverable forwards, NDFs. NDFs are agreements between two parties to exchange the difference in value of an underlying asset, BTC, at expiration. This allows BITW to track Bitcoin without owning the coins. The fund can provide upside if BTC rises while avoiding direct custody risks, volatility. But imperfect correlation to spot prices and higher fees versus physical ETFs are drawbacks. BlackRock is the world's largest asset manager, so their ETF approval is a big step for greater Bitcoin institutional acceptance. Expect more mainstream investors considering crypto exposure. However, purists argue futures-based funds miss the point of direct ownership central to cryptocurrency investing. Regulators remain hesitant on direct custody ETFs due to security concerns as well. Overall, it's a positive step, but not the true Bitcoin ETF debut some were hoping for. Expectations are a spot ETF is still at least a year away pending adequate oversight progress. Hybrid solutions like this may thrive in the meantime. Here are a few thoughts on how BlackRock's Bitcoin ETF could impact BTC price and accessibility. Institutional flows. Big money managers like BlackRock oversee trillions, so their allocation of even a small percentage into a Bitcoin vehicle could spur significant fresh demand. This buys upward pressure on price. Retail adoption. Simply having Bitcoin available like any other stock or commodity fund on traditional brokers opens the door for many ordinary investors still hesitant to deal with private crypto exchanges. Price benefit as user base expands. Index inclusion. Top exchanges may add the ETF to cryptocurrency benchmarks, potentially triggering automated portfolio rebalancing demand each time it trades. Continual buying floor. Alternative to futures. Some institutional traders barred from volatile futures. Contracts may feel more comfortable with the ETF structure, even if imperfectly tracking spot. Every bid helps. ETF momentum. Successful launch could encourage competitors to pursue similar products, from Vanguard to Fidelity and beyond. Early mover advantage cements BTC long-term. Macro validation. Approval from global policymakers and Wall Street's largest player is a massive cultural seal of approval for the new crypto asset class. Bullish long-term. Risks include weaker correlation, draining some novelty, profit-taking if euphoria fades, and regulators maintaining a wary view. But on balance, this expands the eligible buyer pool meaningfully and keeps prices trending upwards over the coming years, in my view. BlackRock Bitcoin ETF differs from other existing crypto investment vehicles. No direct Bitcoin holdings. Unlike a physical Bitcoin ETF, this fund does not actually purchase and hold BTC. It seeks exposure via Bitcoin futures and derivatives only. Exchange-traded structure. As an ETF, it trades on a national securities exchange during normal market hours, allowing simple purchase through traditional brokers just like stocks. Fee structure. ETFs tend to have lower expense ratios than closed-end funds, trusts currently used by Grayscale and others. BlackRock's fee is 0.95% per year. Tax benefits. As a registered investment company, the ETF avoids collective investment, structure tax complications of Bitcoin's trusts, which are taxed differently. Liquidity. ETF primary market liquidity allows authorized participants to exchange creation-redemption blocks of shares for the underlying investments daily to keep market price in line with net asset value. Regulation. It operates under standard 1940 Act rules and oversight of the SEC, as opposed to the less strict rules applied to other crypto investment vehicles by different regulators like the CFTC. Tracking. The fund seeks results that generally correspond to Bitcoin performance via derivatives, but imperfect tracking is inherent to its structure versus physically holding the coins. So in summary, while pioneering access, traditional investors sacrifice some attributes but gain familiar regulatory protections and tax treatment via this type of Bitcoin investment product. These are some key implications this could have for increased institutional adoption of cryptocurrencies. Mainstreaming effect. Getting Bitcoin into the largest asset manager kickstarts far more serious money entering the sector, formalizes crypto as a legitimate new asset class. Fiat on-ramps makes purchasing crypto as easy as buying stocks via existing brokerages without needing to open separate crypto exchange accounts. Lower barriers to entry. Exposure without direct custody. Institutions shy of security risks of holding private keys can gain access via the synthetic product structure of futures-based ETFs. Baby step. Pension fund and endowment allocations. Larger institutional pots of capital may consider small satellite crypto allocations now accessible through familiar ETF wrapper and SEC regulated. Risk appetite rise. As crypto proves uncorrelated to other assets and the asset class matures, expect increasingly larger portfolio allocations beyond initial toe dipping. Fund sponsor competition. Success here will motivate more traditional firms like Vanguard, Schwab, Fidelity to enter with their own crypto investment vehicles commission-free for clients. Policy support signal. Regulator approval of firms crypto transitioning from fringe to accepted part of investor portfolios, allaying compliance, reputational concerns for institutions. Market pegging. Prices may become increasingly anchored to traditional markets and less prone to irrational bubbles, improving asset class stability over time. Overall, very bullish for wider Wall Street and risk-averse money acceptance of digital currencies as investable asset class going forward. Mainstream breakout. Let's hear what some expert opinions on the potential long-term effects this ETF approval could have on cryptocurrency markets. Peter Kovac, global crypto strategist at Galaxy Digital. This opens the floodgates for tremendous institutional capital inflows into the crypto space over the coming years. While some question using derivatives instead of spot holdings, the sheer size of players like BlackRock will expose many new investors long-term. I expect continued products unlocking even greater adoption and maturation of digital assets. Kathy Wood, CEO of ARK Investment Management. Approval of the first Bitcoin ETF in the U.S. underscores secular shift underway toward digitization of money and stores of value. While regulatory tolerance for crypto has progressed gradually, catalysts like this will drive accelerated penetration of blockchain technology across finance. In 10 years today may seem like the early days of internet in late 1990s. Jim Bianco, president of Bianco Research. While not a true physical coin ETF many hoped for, the approval lays groundwork for greater Wall Street involvement that spurs increased price stability and liquidity. As volumes and types of crypto investment vehicles rise, crypto will become less volatile fringe investment and more viable long part of balanced portfolios for both retail and big money. Chris Klein, Chief Operating Officer of Bitcoin IRA. This development puts tailwinds behind Bitcoin's next bull run, taking it well over current all-time highs as money managers open the floodgates. In 5-10 years, a $1 trillion crypto market cap will be small potatoes once institutions truly inherit the earth, increasing adoption exponentially from here. In summary, consistent themes include greater institutionalization supporting higher long-term price levels and increased market maturity as new products drive broader participation. Overall, very additive for crypto ecosystems. Don't forget to like, subscribe, and hit the notification bell to keep up to date with the latest in cryptocurrency.